Hey, I'm Carter, and if you own a manufactured home and you're sitting on some equity, there's a good chance someone has mentioned a home equity line of credit as an option. Or maybe you've looked it up yourself and thought it seemed straightforward. I want to have an honest conversation about that, because I think there are some things worth understanding before you go down that road. First, let's talk about whether it's even possible. Only about 30% of manufactured homes actually meet the core requirements that lenders look for to approve a home equity line of credit. Things like whether the home sits on a permanent foundation, whether it's been converted to real property with a real property title, whether you own the land it sits on, and the age of the home. If any of those boxes aren't checked, the conversation ends before it starts. So before anything else, understand that the odds are already working against most manufactured homeowners on this one. Now let's say your home is in that smaller group that qualifies. You still need to be what I'd call a near-ideal borrower. Higher credit score, low debt-to-income ratio, strong financial profile. The bar is higher for manufactured homes than it is for a standard single-family home. So even when the property qualifies, a lot of homeowners still don't. But let's say you clear both of those hurdles. Here's where I really want you to slow down and think carefully. Because a home equity line of credit comes with risks that a standard refinance simply doesn't have. The rate on a large majority of home equity lines of credit is variable. It moves with the market. And if rates go up, which they can and do, your monthly payment goes up with them, sometimes significantly and with very little warning. A fixed-rate refinance locks your rate in for the life of the loan. Same payment every single month from day one to payoff. If I'm trying to solve a financial problem, the last thing I want is a new payment that I can't predict. There's also something called payment shock that most people don't think about until it hits them. A HELOC has two phases. During the draw period, usually around 10 years, you're often only paying interest, which feels very manageable. But when that period ends, you're suddenly paying principal and interest on the full balance. That jump can be dramatic. A fixed-rate refinance never does that to you. And here's one more thing that doesn't get talked about enough. A lender can freeze or reduce your home equity line at any time. If your home value drops, if your credit changes, if the lender simply tightens their own policies. It happened to a lot of homeowners in 2008. They were counting on access to those funds, and suddenly it was gone. With a refinance, the cash is yours up front. There's no risk of it being pulled back. Now here's something that almost nobody talks about, and it really should be part of this conversation. A home equity line of credit reports to the credit bureaus more like a credit card than a mortgage. So if you draw heavily on that line, even if you're making every payment on time, it can look to the credit bureaus like you've maxed out a credit card. That has a real and meaningful negative impact on your credit score. For someone who is trying to improve their financial picture, that's a significant unintended consequence that could affect your ability to qualify for other things down the road. A cash-out refinance doesn't carry that risk. It reports as a mortgage, not a revolving credit line. Last thing, and this one matters for manufactured homeowners specifically. The rates you see advertised nationally for home equity lines of credit are not the rates you're going to get. Those numbers are built around standard single-family homes. If your manufactured home qualifies and you qualify as a borrower, realistically expect to pay meaningfully more than what's being advertised, which makes a fixed-rate cash-out refinance an even stronger option to at least explore before making a decision. Here's what I know. If you own a manufactured home and you're trying to find the right financial path forward, it's already harder than it should be. The options are more limited, the fine print is more complicated, and there's no shortage of products being marketed to you that aren't actually built for your situation. A home equity line of credit might sound like an easy answer, but for most manufactured homeowners, it's either not realistic to qualify for, or it's simply not the best financial decision when you understand how it actually works. Your time and energy are worth something. Spend it looking into options that are actually designed for where you are and finding an expert who works in that space every day. Check the description below. It's a good place to start that search.